Welcome to Thoughts on the Market. I'm Matthew Hornbach, Global Head of Macro Strategy.
And I'm Michael Gapin, Morgan Stanley's Chief U.S. Economist.
Today, we're going to talk about the Federal Open Market Committee meeting and the path for rates from here. It's Thursday, December 19th at 10 a.m. in New York. The FOMC meeting concluded yesterday with the Federal Reserve cutting rates by 0.25 percentage point, marking the third rate cut for the year. This move by the Fed was just as the consensus had anticipated. However, in its meeting yesterday, the Fed indicated that 2025 rate cuts would happen at a slower pace than investors were expecting. So, Mike, what are committee members projecting in terms of upcoming rate cuts in 2025 and 2026?
Yeah, Matt, the Fed dialed back its expectations for policy rate easing in both 2025 and 2026. They now only look for two rate cuts, so 50 basis points worth of cuts in 2025, which would bring the funds rate to 3.9%, and then only another 50 basis points in 2026, bringing the policy rate to 3.4%. So a major dialing back in their expectations of rate cuts over the next 2 years.
What are the factors that are driving what now appears to be a slightly less dovish view of the policy rate?
Chair Powell mentioned, I think, two things that were really important. One, he said that many committee members saw recent firmness in inflation as a surprise. And so I think some FOMC members extrapolated that strength in inflation going forward and therefore thought fewer rate cuts were appropriate. But Chair Powell also said other FOMC members incorporated expectations about potential changes in policy, which we infer to mean changes about tariffs, immigration policy, maybe additional fiscal spending. And so whether they baked that in as explicit assumptions or just saw it as risks to the outlook, I think that these were the two main factors. So either just momentum in inflation or views on policy rate changes, which could lead to greater inflation going forward.
So, Mike, what were your expectations going into this meeting, and how did yesterday's outcome change Morgan Stanley's outlook for Federal Reserve policy next year and the year thereafter?
We are a little more comfortable with inflation than the Fed appears to be. So we previously thought the Fed would be cutting rates 3 times next year and doing all of that in the first half of the year. But we have to listen to what they're thinking, and it appears that the bar for rate cuts is higher. In other words, they may need more evidence to reduce policy rates. 1 month of inflation isn't going to do it, for example. So what we did is we took one rate cut out of the forecast for 2025. We now only look for 2 rate cuts in 2025, one in March and one in June. As we look into 2026, we do think the effect of higher tariffs and restrictions on immigration policy will slow the economy more. So we continue to look for more rate cuts in 2026 than the Fed is projecting. But obviously 2026 is a long way away. So in short, Matt, we dialed back our assumptions for policy rate easing to take into account what the Fed appears to be saying about a higher bar for comfort on inflation before they ease again. So, Matt, if I can actually turn it back to you, how, if at all, did yesterday's meeting and what Chair Powell said change some of your key forecasts?
Yeah, so we came into this meeting advocating for a neutral stance in the bond market. We had seen a market pricing that ended up being more in line with the outcome of the meetings. We didn't expect yields to fall dramatically in the wake of this meeting, and we didn't expect yields to rise dramatically in the wake of this meeting. But what we ended up seeing in the marketplace was higher yields as a result of a policy projection that I think surprised investors somewhat. And now the market is pricing an outlook that is somewhat similar to how the Fed is forecasting or projecting their policy rate into the future. In terms of our Treasury yield forecasts, we didn't see anything in that meeting that changes the outlook for Treasury markets all of that much. As you said, Mike, that in 2026, we're expecting much lower policy rates, and that ultimately is going to weigh on Treasury yields as we make our way through the course of 2025. When we forecast market rates or prices, we have to think about where we are going to be in the future and how we're going to be thinking about the future from then. And so when we think about where our Treasury yields going to be at the end of 2025, we need to try to invoke the views of investors at the end of 2025, which of course are going to be looking out into 2026. So when we consider the rate policy path that you're projecting at the moment and the factors that are driving that rate policy projection, slower growth, for example, a bit more moderate inflation, we do think that investors will be looking towards investing in the government bond market as we make our way through next year, because 2026 should be even more supportive of government bond markets than perhaps the economy and Fed policy might be in 2025. So that's how we think about the interest rate marketplace. We continue to project a 10-year Treasury yield of just about 3.5% at the end of 2025. That does seem a ways away from where we are today with the 10-year Treasury yield closer to 4.5%. But a year is a long time, and that's plenty of time, we think, for yields to move lower gradually, as policy does as well. On the foreign exchange side, the dollar we are projecting to soften next year, and this would be in line with our view for lower Treasury yields. For the time being, the dollar reacted in a very positive way to the FOMC meeting this week. But we think in 2025, you will see some softening in the dollar. And that primarily occurs against the Australian dollar, the euro, as well as the yen. We are projecting the dollar-yen exchange rate to end next year just below 140, which is going to be quite a move from current levels. But we do think that a year is plenty of time to see the dollar depreciate. And that, again, links up very nicely with our forecast for lower Treasury yields. Mike, with that said, one more question for you, if you would. Where do things stand with inflation now? And how does this latest FOMC signal, how does it relate to inflation expectations for the year ahead?
So right now, inflation has been a little bit stronger than we and I think the Fed had anticipated, and that's coming from two sources. One, hurricane-related effects on car prices. So the need to replace a lot of cars has pushed new and used car prices higher. We think that's a temporary story that's likely to reverse in the coming months. The more longer-term concern has been around housing-related inflation, or what we would call shelter inflation. The good news in that is in November, it took a marked step lower. So I do think it tells us that that component, which has been holding up inflation, will continue to move down. But as we look ahead, to your point about inflation expectations, the real concern here is about potential shifts in policy, maybe the implementation of tariffs, the restriction of immigration. We as economists would normally say those should have level effects or one-off effects on inflation. And normally I'd have a high confidence in that statement, but we just came out of a very prolonged period of higher than normal inflation. So I think the concern is repetitive one-off shocks to inflation lead inflation expectations to move higher. Now, we don't think that will happen. Our outlook is for rate cuts, but this is the concern. So we think inflation moves lower, but we're certainly watching the behavior of inflation expectations to see if our forecast is misguided.
Well, great. Mike, thanks so much for taking the time to talk.
Great speaking with you, Matt.
And thanks for listening. If you enjoy Thoughts on the Market, please leave us a review wherever you listen and share the podcast with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.